Every country on earth is in debt. It does not matter who is in power, what system they use, or how rich they are. The number only grows. Today, that number is over 300 trillion. If everyone owes, then who is being paid? The answer is not simple. And it is not comforting, because the truth is, the debt is not a problem to be fixed. It is a system, one that was built piece by piece, step by step, to ensure that no one could escape. And you are already inside it. Before 1694, government debt was temporary. Kings borrowed from merchants or nobles one lender, one loan, a personal deal. They promised to repay with interest. If they could not, they defaulted. The lender lost, the debt disappeared, the cycle restarted. There was no system, no machinery, just risk and personal trust. Then William Paterson proposed something different. England was broke. At war with France, King William III needed funds, but traditional lenders wanted nothing to do with unpaid promises. Paterson offered a solution. Raise a large sum, £1.2 million, but never repay the principal. Instead, let the government pay interest forever. Parliament agreed. Paterson and his network received 8% annual interest locked in for life. The loan became permanent, and to manage it, they created something new: the Bank of England. This was the first chain. Because Paterson's genius was not just lending money. He introduced the idea that government debt should never be clear-only serviced. The system rewarded the lender not when loans were paid back, but when they were never paid back. And he built a second layer: paper money backed by government IOUs. The more debt the government took on, the more money the bank could issue. Debt became currency. Currency became interest. And interest continued forever. Every modern central bank that followed copied this model. The consequences were long-term, silent, and powerful. National debt became the foundation, not a flaw. And taxpayers became the source of eternal repayments. England never cleared that debt. It still exists 300 years later. The first chain was locked the day the loan was signed, and no one has broken it since. By the early 1800s, European governments were comfortable using debt. They borrowed to fund wars, infrastructure, and expansion. But loans were still isolated. Each deal was a one-on-one negotiation, slow, unstable, and mostly inaccessible to the average investor. Nathan Rothschild changed that. He built a transnational banking network across 5 major cities: London, Paris, Frankfurt, Vienna, and Naples, linking capital in a way no one had done before. But his real innovation was the secondary market. Instead of granting loans to governments directly, Rothschild bought government bonds at a discount and resold them to investors' pension funds, insurers, wealthy individuals. He earned the spread. Everyone else held the debt. Governments received fast cash. Rothschild got permanent leverage. The investors got steady interest, but something more dangerous happened beneath the surface. Debt became movable, detached from its original context. A British bond might be owned by a French bank, then sold to a German investor, then used as collateral in Austria. This was the machine. Debt was not a risk, it was a product. It could be sold, renamed, repackaged, and traded across borders. And once sovereign debt spread too far, default became catastrophic. One missed payment would not just harm one banker. It could unwind entire financial systems. This was Rothschild's true power. By turning government debt into a global product, he made it immune to erasure. No single country could collapse it because all other countries now depended on it. Rothschild did not invent lending. He invented the conditions where default was no longer allowed. From that point on, no government truly controlled its debt. They managed it, they avoided collapse, but real escape was no longer possible. By the early 1900s, the United States was becoming a global economic force, but its financial system was still brittle. Banks collapsed often. Money was scarce in crisis. And the federal government lacked centralized control. J.P. Morgan saw the flaw in the opportunity. After the panic of 1907 brought the banking system to the edge, Morgan personally stepped in. He rallied the nation's top bankers, pooled their money, and stopped the collapse. But even Morgan knew this could not be done twice. A deeper structure was needed, one that could act like a centralized lender, without the political baggage of calling it a central bank. The solution arrived in 1913, shaped by a secret meeting on Jekyll Island. The men who attended bankers, senators, and Morgan's closest allies designed the Federal Reserve System. Publicly, it looked decentralized. 12 regional banks, a board of governors, government oversight, but structurally, it ensured the ongoing influence of private banks. These banks owned shares in the regional feds. They elected members. And the most powerful of them, all the New York Fed was, operated directly by Wall Street's biggest institutions. Here was the breakthrough. The Federal Reserve could create money, not from profits, not from taxes. It simply bought government debt, and in doing so, expanded the money supply. Now, government never had to find money to borrow. It just printed bonds. And the Fed printed the funds. The cycle was complete. Government borrows, gives, Fed buys, gives, money created, gives, taxpayers pay interest, gives, borrow again. There was no longer any limit to debt because there was no longer any limit to who could buy you torn how. J.P. Morgan died in 1913. So did the idea of natural limits. By the late 1970s, the world was drowning in cheap credit. Developing countries had borrowed heavily in dollars, encouraged by low interest rates and the promise of growth. Then inflation hit the United States, and with it, global trust in the dollar began to erode. Paul Volcker, chair of the Federal Reserve, responded with something no one expected. He raised interest rates to levels never seen before. From 11% to nearly 20% in 2 years for the U.S., it worked. Inflation collapsed, but for the rest of the world, it was devastating. Countries like Mexico, Brazil, and Argentina suddenly faced impossible repayments on their dollar loans. The rates had tripled. Their export revenues were no longer enough just to cover interest. Default seemed inevitable, and it should have been, but the system had a back door. Instead of allowing defaults and wiping out the bad loans, the IMF stepped in not to forgive the debt, but to refinance it. These were not rescues. They were restructures. The money was lent not to grow these economies, but to ensure the original interest kept flowing to Western banks. And the loans came with conditions: cut spending, sell public assets, let foreign corporations in, devalue your currency, surrender control. This was not just monetary policy, it was a shift from debt as necessity to debt as leverage. Volcker had forced a new rule into place: if a nation cannot repay, do not forgive its debt, restructure it, bind it into rules. Extract compliance, the trap was now global. An escape no longer meant default, it meant giving up control. Today, the world owes more than $315 trillion, 3 times the size of the entire global economy. Every country participates. The United States owes over $38 trillion. Japan owes $9 trillion. Europe, China, and dozens of smaller nations all run on evolving debt cycles. Borrowing, rolling it over, and borrowing again. But here is the paradox. No one is outside this system. And no one is trying to escape it, because escape would break everything. Roughly half of the U.S. debt is held by its own institutions, pension funds, mutual funds, insurance companies, and the Federal Reserve itself. The other half is owed to programs like Social Security and Medicare. This means the government owes money to itself, but servicing that debt still requires taxpayer money. The interest flows upward from workers, through taxes and inflation, into the hands of asset managers, financial institutions, and bondholders. Globally, it gets worse. Japan holds U.S. bonds. The U.S. owns European debt through the IMF. Europe holds developing nation debt through the World Bank. Everything is interlinked. Default is no longer an option because hurting one node of the system could break all the others. The network is circular. Debt bounces between accounts. But the interest is always real, and it always flows to the top. And even if a government wanted to pay off its debt, it could not, because paying off debt destroys money. Money is created when debt is born, especially in countries with central banks. If a country like the U.S. erased $38 trillion in debt, It would erase the equivalent amount of dollars from the economy. Markets would freeze. Banks would fail. The system would lock. That is why no country will ever pay it back. Because the debt is not the problem. It is the engine. The debt trap is not a bug in the system. It is the system for over 3 centuries. One idea has been refined, scaled, and globally enforced. Make debt permanent. Make repayment impossible. Make interest eternal. William Patterson made government debt endless. Rothschild made it untouchable. J.P. Morgan made it infinite. And Volcker helped make it global. Today, no nation escapes. Debt has become our default currency. Not something borrowed in crisis, but printed, traded, and owed as a matter of routine. Every taxpayer funds it, every institution profits from it, and every generation inherits it. The reason no leader ends it is not fear. It is design. Collapse would follow anything that truly cleared the debt. The supply of money itself would shrink. So governments must keep borrowing not because they are reckless, but because the machine they operate requires motion. You are not witnessing a failure. You are witnessing a success story for those who built it. What you call crisis, they call return. And unless the system itself is replaced, the rent will keep flowing upward. If every dollar of debt is someone else's asset, can the system ever be cleared without destroying the wealth of those who control it?